stuck in a range, moving sideways since October. Is this market going to crash? Let's take a look at the charts and get an idea of what could happen over the next couple of months. What's going on, everyone? Jeremy Ritz here. Courage pays better than fear. And there's a lot of talk right now about the market getting ready to crash and dump. We're due for a correction. We've been moving sideways. And so we're just going to take a look at the charts and see where we are, what potentially could happen. But what I wanted to share with you today is I went on to Grok on my X account and just asked about certain things related to crashes, recessions, one being the Hindenburg Omen, the yield curve, the stock prices being elevated in relation to the great financial crisis, Great Depression, dot-com bubble. What is sentiment? What is the call put ratio? What are margin levels at? And the Warren Buffett Indicator. And here's what it says. So you can read through this and I'll just do a summary of this. So the Hindenburg Omen status, it's a technical indicator signaling potential market crashes based on factors like new highs, lows, so on and so forth. And its most recent occurrence was February 26th. So we had a Hindenburg Omen and we've seen several of these in this past month of February. So it says, while not a guaranteed predictor, repeated triggers suggest heightened downside risks in the near term. When we look at the yield curve and recession signals, the U.S. Treasury yield curve is currently upward sloping, normal and not inverted, with the 10-year minus the 2-year spread at approximately 0.6% as of February 26th. This positive spread does not currently indicate an imminent recession. Positive in terms of there not being a recession. And it says the New York Fed assigns a 27% possibility of recession by this September. How about stock price valuation compared to historical bubbles? So if we look at this, stock prices as measured by the Shiller-Cape ratio are currently around 40 as of February 2026, marking the second highest level in history, exceeding valuations before the Great Depression and the global financial crisis. That was in 2027, but it is below the dot-com bubble peak of 44 in 2000. How about market sentiment? Market sentiment is currently neutral to fearful, so it is not extremely exuberant optimistic, all right? So typically around market tops, you will see unbridled enthusiasm, exuberance. We're not seeing that right now. How about call levels in relation to puts? Call activity is moderately elevated related to puts, indicating bullish but not extremely overdone sentiment. So it's not at extremes. But check out this one, margin debt. Margin debt is at all-time highs and exhausted, surpassing levels from prior bubble peaks. That is interesting. Adjusted for inflation, it's also at a peak exceeding pre-dot-com and pre-great financial crisis levels relative to GDP or market cap. This indicates high leverage similar to bubble eras, increasing vulnerability to corrections. And then finally, the Warren Buffett Indicator status. So the Warren Buffett Indicator is at approximately 220% as of February 26, an all-time high, signaling extreme overvaluations. Levels above 200% are considered playing with fire, and this exceeds peaks before the 2022 correction, and that was the last bear market, and prior bubbles. Historically, such readings precede crashes, though critics note it may overlook globalization and tech-driven margins. The indicator is triggered for potential downsides. Here's just putting everything into consideration. This is why people are so fearful, because the market has been hanging out at highs. You have all these things flashing. You have all the doomers out there saying we're about to come down, but just looking at the charts, we can see we are due for a correction. Let's take a look at it and see what levels we can potentially drop to here in the near term if things flip bearish. So here is the SPX chart, and you can see that we have really been trading inside of a range since October, and we have been moving sideways. We're not really making massive new highs. We've just been hanging out, and this all comes after the big drop that we had last year. You can see where I have this circle. This was when we peaked out last February and dropped and made those April lows here on April 7th, down a little over 21%. And then we just started this huge rally pushing up to where we are now. But the crazy thing is, in the midst of this push higher, the biggest pullback that we've had on the SPX has been 5.75%. And that started at the end of October and went all the way through November. And we haven't had a 10% correction. And with the selling that has been coming into the market, a lot of people have been saying, wow, these sell-off days have been huge. But if you look at it in relation to where a 5% pullback would take us from the most recent high that we printed here in the SPX, which was over 7,000, we have a lot further to come down. And you can see that today, at the time that I'm recording this, we did drop down on the SPX, bounced off the 100, which is where the point of control lies. But you could see we have lots and lots of room to go just for a 5% pullback, which is completely healthy. That would take us down to 66.51. But you could see, if you're questioning where's a 10% correction, that's all the way down here at 63.0210, which would take us back to prices in August. And that is a true potentiality here because we just haven't had a reset in valuations. And you can see that is below the 200-day simple moving average. Now, but what I want to point out is we do have two unfilled gaps that we need to pay attention to. One being here from June 23rd, and I'm going to label this unfilled gap. Unfilled gap. And we have another one below that from this date was May 9th. So you have two unfilled gaps. One is not down to 15%, it's right above it, but you have one that is even further down below 15%, closer to 20%, that we need to keep an eye on as well. And remember, markets can correct 20%. It's when you go lower than 20% where you hit bear market territory. You can see where that would take us down into the lows from last year that we made before that big run up. But we could see that we are due for at least a 5% pullback, which the market has not been able to put in since we have to go back to October. So the question is, with all those indicators flashing, the Hindenburg Omen, the Warren Buffett Indicator, the AI trade potentially being overheated, we're seeing maxed out margin, things are ripe and set up for a drop. But here's the unique thing is everybody is so fearful right now in the market that things are going to drop that it doesn't come when everybody expects it. It will come out of left field. And who knows when this thing will drop or if it even does that, because right now what we're doing is just moving sideways and we are correcting in time, which means that as we're moving sideways, these moving averages are catching up to the price. And so maybe we continue to do more of that. We move sideways, the moving averages catch up. There's not a huge drop and we just continue to ping pong back and forth. But keep in mind too, in mid-year election years, you typically have a weak February, a little bit of a run up in March into the middle of the month, and then a drop from that period all the way through the end of September. So let's see if that holds true for now. But one thing is evident, we are extended. If you just look at the charts from a technical perspective, we are overdue for a drop. We have put in lower lows here. We've been making lower highs. So the structure is giving us that warning that, hey, potentially this can roll over. So there you have it, just an update on where we are in the markets. There is the potential for this thing to drop and for us to get that true 10% correction. And let me know, what do you think? Are we going to roll over? Are we going to get 10, 15, 20% correction or a full-on bear market? Let me know down in the comments below. I'd love to hear your take. Make it a great day, honor the moment, and as always, be grateful. Take care, everyone.